Michael, thank you for coming. So, Draghi signals ECB to join forces with governments to buy bonds. Draghi says high yields are unacceptable, euro is irreversible. And ECB's Draghi says governments must stand ready to activate EFSF. Is Draghi full of promises at this moment?
Well, it's certainly much more of the same that we've heard from the European Central Bank, and it should be no surprise. This is a problem which is both monetary-driven as well as fiscal-driven. Monetary-driven because low rates have caused tremendous debt. Fiscal-driven because all these governments have built up this debt under their watch. Now, the most important part about Draghi's talk today is this idea that they are willing, the European Central Bank is willing to step in effectively to buy Spanish and Italian debt if things worsen. So this has been something I've been saying for quite some time now. The most likely course of action is to keep the pressure on the Spanish government as well as the Italian government through high yields, but to do it in such a way that it does not send the entire system into a tailspin. The way that you do that is by putting a ceiling on how high those 10-year bond yields go in Spain and in Italy, such that the pressure is still there, but you will not have a Lehman repeat.
He said the ECB's focus is on shorter yield curves. Then what's going to happen to the long term?
Well, I think it's an interesting calculation that Draghi is trying to make here. If you try and prevent the short-term funding stress, then perhaps you're able to then force the fiscal side to focus on longer-term budget cuts and more austerity, which can bring down debt over a multi-year cycle. If you take out some of the near-term pain, then maybe the focus can be more on longer-term planning to ease this overall debt level. So I think that's a very interesting way of targeting how to go about this huge deleveraging process that Europe is going through.
I know while we were listening to my co-anchors, you were watching the U.S. market. I was watching it. The reaction. How is the U.S. market reacting to it, and what should we expect next?
So before Draghi spoke, futures were fairly strong, and Europe's markets were also fairly strong. The moment Draghi spoke, obviously the exact opposite happened. There was a strong sell-off. Now, this seems to me like a very much a knee-jerk reaction.
Knee-jerk. Right. I like that.
Meaning it's just sort of a, there was no actual monetary policy announced, so the first reaction is sell. The thing is, and I've maintained this idea for a while, if you prevent the event, you can rally forward in risk assets. Now, the event meaning this idea of another Lehman, another 2008. Draghi saying they will step in if needed. It looks like Europe could be nearing that juncture, means that they're willing to prevent the event. So I think actually you could very easily see a recovery, and while Europe is trying to figure out the next step here. The most important thing for the market is to be comfortable taking risk. To be comfortable taking risk, you have to prevent the event.
So do you foresee a rally?
Equity markets...
After, I know they've been very fragile and they're very sensitive, but what do you see?
Well, I think, look, it's clear that the entire global system is still fragile. Yes. The United States stock market has done relatively better than most others. We're still up roughly, I believe, 8% on the S&P, which is actually phenomenal returns in the face of this tremendous negativity happening globally. I think there's still a very high probability here that China is going to stimulate, which could, that in and of itself, help to push some more money into the system. And I still think that the European Central Bank is going to try to surprise later on in the year. The Fed has been holding back in terms of doing another form of quantitative easing. They already have their extension of Operation Twist. They're already trying to say, we will step in, much like the ECB, if things get worse. But right now, we're going to wait and see. I think there's going to come a moment where if it looks like things are really going to fall off of a cliff,
they will do something?
You will see global coordinated central bank action. Including
Fed?
I think the entire world.
When do you expect Fed to take action?
Quite honestly, if the S&P were to drop precipitously, because that's effectively where a lot of the wealth in the United States has been created, as well as in this recovery in housing.
Define precipitously.
Meaning in a very fast way. If you see suddenly the stock market collapse.
Going down percentage-wise.
10% in a month.
Is that what it is?
Something like what happened during the summer crash of last year.
I see.
Then the Fed likely has to step in. Because at the end of the day, there is a wealth effect that comes from rising stocks and from a recovering housing market. If those two start falling in a major way, the Fed is probably going to have to try and soften that blow to the economy as a result. Now, every single market in the world is correlated because of globalization. Central bank action is correlated as well. So the moment the ECB decides to take on some kind of aggressive step, I suspect you will see all central banks
All of
globally
them will act
at once.
It's funny, it's interesting, and it's ironic, actually. I sent it to my producers too. You have this article in Wall Street Journal online version, Central Bank Paranoia Returns. And you wrote it like a couple days ago. I think paranoia can be instructive in the right doses. Paranoia is a skill. And you addressed this many times over a 2008 repeat, right? So what do you mean here? Is this a paranoia that we're in right now too?
Well, look, I think if you are Mario Draghi, every single day you have to wake up and ask yourself, am I going to keep my job if there's going to be a Lehman repeat? Because quite frankly, if Spain goes, the euro goes, the European Central Bank goes. It's really as simple as that. So out of pure self-preservation, Draghi and all of his central bank friends are going to be waking up paranoid about what happens to financial markets. What that means is that they have to take out more and more insurance against some kind of a collapse, more and more liquidity against some kind of a collapse. So that paranoia can be the bull investor's friend, because as long as they are there to try and push money into the system, then you can still have a rally in risk assets.
It's funny that you say that. If Draghi wants to keep his job, he's been there for 9 months, then he has to prevent a 2008 repeat. My co-anchor, just before he introduced us, said that the money is in Germany's pockets. Is it all about Germany?
It has been for some time.
Is it not Draghi, but Germany? And how is he going to do it without their, also permission? Maybe he's not going to give the banking license, but how is he going to, coordinate all of it?
The moment it starts hitting home in Germany, and it's starting to affect Germany's economy, I think you'll begin to see Germany blink in terms of their willingness to try and ease the crisis. Germany has been the entity which has been so against any kind of monetization, so against anything except austerity, because their economy has been relatively better off, and they've benefited from this crisis. Let's not forget, all that money that fled the pigs, Portugal, Ireland, Italy, Greece, and Spain, has gone into German bunds.
That's right.
So their interest costs have lowered. Germany has been directly benefiting from this. There will come a moment where that will reverse, where Germany's economy will begin to feel it more and more. And I think when you start to see that stress, you'll see Merkel start to say, okay, you know what, we'll allow you to monetize somewhat. They will ease that hardline stance.
So today's Mario Draghi's comments, and we were talking about the body language too, investors are reading everything, and they're reading into everything as well. Is it going to be super negative? What should we expect by the end of the day today?
Well, I wouldn't be surprised, actually, if you did have somewhat of a recovery into the close, because as money begins to act a little bit more rational following this announcement, money might start to say, okay, they are assuring us once again that they will do whatever it takes to prevent a collapse. That might be just enough for money to get comfortable, especially when bond yields are so low in Germany, in the United States, especially when the yen in Japan is so high, the so-called risk-off trade, the safety trade. We're at a very critical juncture here where you have tremendous bearishness built into a lot of intermarket relationships. Any kind of a feeling, literally any kind of a whiff that things might be okay, that Europe might survive, that Spain will not send the financial system into a tailspin, means you can very easily undo that bearishness that's being priced in. Now, there are a lot of studies that show that confidence is almost more important than action. If Draghi is confident in his rhetoric and appears as, let's call it, the savior of the Eurozone, at least in the short term, the market will begin to believe him independent of no policy action. Because confidence, and again, this is purely about psychology. Now, that happens, the market will begin to behave as if monetization is underway. The market will begin to act as if stimulus is underway, even though it's not, and begin to react accordingly, easing much of these strains.
I like the way you correlate every market to each other in terms of the global markets as well, and you're right. And I would like to look at a broader picture. U.S. fiscal cliff is, getting closer. They're trying something. China's growth slowing. Europe's banking financial crisis is there. When you look at all this picture, from a distance, what do you tell your investors? Where do you tell them to invest in, taking also into consideration that all those four markets, gave us gain within the last month: commodities, equities, bonds. What do you tell your investors in the U.S. investors? And this is my last question.
Well, I think number one is not to panic, because everybody's looking at the same picture. So by definition, if everyone is looking at the same picture, there's nothing new in that picture. Everywhere you look, it looks negative. And if you've been a bear on the economy, you've been right. But still, as you just said, almost every single asset class has produced strong returns. So at some point you have to ask yourself, is my view of the world unique, or is it already priced in through these panic levels that are happening in the bond market? Now, the most important thing, don't be buy and hold, buy and rotate, be nimble, and
don't buy bonds.
I think bonds are incredibly overvalued, because after inflation, you take a guaranteed loss. In the U.S. government, treasuries yield less than the rate of inflation. I think that the next real step here is for risk-taking.
Perfect. Thank you so much, Michael, for coming to our studios and sharing your valuable information, and also sharing what you recommend to your investors.